We'll talk about 5 trading strategies: trend and angle, SP reversals, the TDI Hook, the TDI Squeeze, and the TDI Hidden Secret. Those are 5 strategies. Now, some of these I've talked about before in some detail, but tonight I want to give a little bit new information for each one and kind of clarify what we're wanting to do with each strategy. Now, the trend and angle is the standard TDI strategy, and there are 5 key steps to doing this particular strategy. We're going to simply look for green line and red line crossovers. And at the crossover, what we're looking for is strong angle in the direction of the overall trend. Now, remember when I said the overall trend, that is the market baseline. The yellow market baseline represents that overall trend, direction. That's what we're looking for, okay? Then what we're going to do is we're going to compare the direction of the price action and the TDI green line. Now again, I'm the type of trader who really concentrates on price action. I look for patterns because based upon the history of chart patterns will typically complete, let me rephrase that, will historically complete 65 to 85% of the time. Now I know that may sound like a large variance. Well, you have to add in fundamentals in the market, news, and other potential things that could throw a pattern a little bit off, but more times than not, a pattern will complete. So if I have let's say I have a head and shoulders pattern, and my green line is showing to the downside, what trade am I looking for? I have a head and shoulders price action pattern, my green line's pointing down, and let's say my green line is under the market baseline. What is the probable trade that I've got going on at that moment? That's right, a short. A short trade is going to be highly likely at that moment in time because I've got my RSI price line rolling over and going down, my green line. So I've got basically market sentiment going a direction and price action going a similar direction. I'm looking for the market to continue making a push to the downside. Okay? Now, enter the trade of price action and the TDI and the overall trend are all favoring one another. Okay, so again, head and shoulders pattern, TDI is going down, and the market baseline is also looking to go down. And maybe even the overall trend on a larger time frame, maybe my 1 hour price chart is showing me an overall trend of the downside. Just taking a big picture of my time frame. If I'm trading, let's say, down a 15-minute chart, I'm seeing the market move over to the downside. I can enter that trade to the downside, and then I look to exit when the green line crosses over the red, the blue, or the yellow lines in the opposite direction. I'll look for that. So let's take a look here at what I'm getting at. Now that I've said all that, what does it look like? This is what it looks like right here. We have a beautiful crossover right here. And remember what I said about the market baseline? Remember, the market baseline is the fluid or dynamic 50 level. So do I need to sit here and wait for the green line to get to 50 as you would maybe in RSI? No. I can start entering my trade at this point right here. As I cross over, I've crossed the red to the upside, I've crossed the yellow to the upside, and I would think you'd have to agree with me that what we're looking at right here is some pretty good angle and pretty good trend. I mean, that's a pretty good angle right there. And we also have good separation. So we have our trend turning. Now, oftentimes people ask me, but Dean, are you a little concerned that the market baseline was kind of coming down? Well, what I look for when the green line crosses the market baseline, the yellow line, is I'm wanting that yellow line to more or less be flat. If it's flat or turning in the direction of where I'm trading, I'm okay with that. I just want to avoid the X. When the green line's going down strong and the yellow line's going down strong and the green line's going up strong, forming like an X formation, that's not the best trade situation. We'll see that here in a moment. So this is, if I was to take a picture and put it on the wall of what it would look like starting out, this would be it. Now, all of us including myself, I mean, every trader out there, we are experts at chart history. So, you know, did I go back and find a textbook perfect picture of what trend and angle would look like? Yeah, of course I did. I had to have a textbook model of it. But is that what we're going to get every time? No. As a good friend of mine told me one time, I went and visited with her and was sitting in her trading room, and she had all these pictures on the wall. And all these pictures show the market starting out, of what she looks for when the market's starting out, based upon her trade setup. And she said, Dean, I don't know if that trade's going to work out or not. I don't know if it's going to go to 20 pips, 40 pips. I have no idea. But I know what to look for when it starts. And I asked her why she did that for. She said to keep my eye on the prize. Because if I can define very clearly what it looks like when it starts out, then it falls back on me to do money management and to do risk management and to see this trade go through. That's the key. So that's what we're looking for here. Now let me continue here, and we'll talk a little bit more about this. What we're looking for with that green line, now imagine, if you will, I often tell folks, imagine, if you will, you had a clock face. And this clock face, you have the hands of the clock here. Let's say these are the hour hands. And what we're looking for is the green line of the TDI to be similar like what we see here, between 12:30 and 2 o'clock. That's the angle that we're looking for a potential long trade. Is everybody with me? I hope I'm not losing anybody. I've got a number of people here in the room, but I just want to make sure that everyone is with me. Does everyone understand what I mean when I say the green line is representative of the clock face between 12:30 and 2 o'clock? That's more or less the direction I want it to go. All right? Good. Now then, at that point, I'm not so concerned about the angle of the red line, but I like to see good separation between the two. This is telling me that my moving average, my faster moving average of the RSI, that's making a strong move, and this is following it. That's exactly what I'm looking for. Now, let me show you something. Notice how, in this case, we have the same look. Wouldn't you agree that's pretty well the same look? The only caution here is that the market baseline is way up high. Yikes. You could potentially get in trouble here because, like I said in that example of the runner running up a hill, he can only go so far before he gets into a level of exhaustion, buying exhaustion over the 68. It would be much better if you entered the market here and had that potential to run up. We're above the yellow line, which represents the dynamic 50 level. Okay, this is representative of the 50 level dynamically. There's a lot of potential here. But when we're attempting to trade, and I've done it personally myself, and I've seen other folks do it as well, when you trade up high like this, going long, is there potential it could keep going? Yeah, but look at the market here. See how choppy this market, it tries to make a move, and tries again to make a move, and just not seem to do it. Compared to what we had over here, where the market went down to a low and worked off of, maybe there was some news, I'm not sure, but the market worked off of a low point here. See how many lows we have here? You couldn't get any lower, and the market starts making a move to the upside. Okay? So sometimes this is a probable trade. You have to realize that it's a limited amount of move to the upside that you have left. So be careful when your market baseline is up high and you're going long. I would suggest to you that if the market baseline is up above the 68 and the green line is above going higher, be very careful, especially on the smaller time frames. Now, just on the flip side, what we're looking for is the green line having a good angle between 4 o'clock and 5:30. And I would have to say, that right there looks pretty much like a 5:30 angle. Now that didn't right there, but this looks like about maybe a 5 o'clock angle. And I've got good separation going on here as well. Okay, so when we cross the market baseline up high, we have a lot of potential here. Again, market baseline representative of your 50 level, but a dynamic fluid 50 level. Okay, and you can see how the market's trying, can't get any higher, and then it falls over. And it comes back, takes a little bit of a breather, and then starts working its way bit by bit to the downside. Well, we're getting that right there. Okay. Now, again, like I mentioned with the long trades, when your market baseline is down low, I'm going to caution you to go short. Now, this was a nice trade going short, but we're way down low. So you have to, you have to take a little bit of caution when you're trading short, when your market baseline is way down low. Be careful of that. It does have good angle, good separation, but your market baseline is down low, and you're getting into that oversold or selling exhaustion phase down in this area. So be cautious of that. As a matter of fact, where we entered here, based on what I see here, we probably entered, let me just take a look here. If I run this, let's say we run this straight up. It looks like we could have entered on this particular trade somewhere, it looks like close to around maybe 99.75, and we had a push down here, and it turned back to the upside back here. Maybe a 20 pip trade right there, possibly a 20 pip trade right there. But we got to be careful, because not always do we have these good moves to the downside. And this is on a 15-minute chart. This is a decent little trade right there. So let me give you a summation of trend and angle here. We have angle of green line between 1230 and 2. The market baseline is flat or rising between 32 and 50. Okay? That's the yellow line. And avoid entry or be cautious of entering when that market baseline is too high, especially if it's near 68. Okay? And when we're trading short, similar, but just the opposite. You're looking for good angle of the green line between 4 o'clock and 5:30. The market baseline is flat or falling between 68 and 50. It gives you a good potential trade. And avoid entering when the market baseline is too low or near 32. Now I'm going to share something. My personal thought is this. If I'm down a 5 or 15 minute, which I normally trade as an active trader. Now I'm going to remind you, the Trader's Dynamic Index can be traded on any time frame. I just realized that on the smaller time frames, when you're down, or when the market baseline is down around 32, or the market baseline is at 68 or above, be ready for reversals to happen, and they can come pretty quick. Okay? Be ready for reversals to happen. They can come pretty quick. Okay, good. Let's move on. So the next one here, now that one was the basic trading concept that everybody understands. Now let's talk about SP reversals. Now I already mentioned something about this a little bit a while ago. I want to talk about a little bit more in detail. We're going to monitor the 4-hour and our daily charts. We're going to look for the market baseline, the yellow line, to hit 32 or hit 68. Now, let me share with you that can it go beyond those levels? Absolutely. I mean, I've seen the market baseline get down near 20. I've seen the market baseline get near 80 or 85. So they can get up or get beyond those levels, okay? We wait for the yellow to close after hitting the level. So what we're looking for is for the yellow line to start turning over. So let's say in this case it closes lower after hitting the 68. So it's gone up to 68. Maybe it went to 70, 75, but it starts to turn over. It starts to roll over and down from the 68, okay? Or it starts to turn higher up from the 32. Again, we're going to compare price action to the Trader's Dynamic Index. We're going to enter a trade when the green, red, and yellow lines cross over in direction of a reversal move, okay? So like when the yellow line comes up to 68, starts to roll over, we're looking for that reversal. Exit when the green line closes after the crossover of the yellow line. Now, the focus here, again, is green line and yellow line. We'll talk about that as we take a look here. This is the example that I talked about earlier. Again, look for the market baseline on a 4-hour daily chart for potential reversals when we get up in those levels. Now here's an example on February the 10th of what took place. You can see that the market went up above the 68 level. Okay. You can also see that the market baseline went right up to the 68 and couldn't seem to go any further than that. Just kind of sat there. Okay. And then look what current price did. Current price started dropping below it. So also you see this pattern right here. And that's something I'm going to refer to often as where you talk about the Trader's Dynamic Index, is make note. This isn't a specific strategy, but it's something that I also look for. As I look for price patterns, or chart patterns, should I say, within the TDI. You can see right here, do you see this double top? And this is a lower high than this high, or this top is lower than this top. You see that? So we see here a double top happening near the high of the market baseline. This is a down signal. Exactly. Regular divergence. Exactly. And notice here too, this double top actually occurs in the Trader's Dynamic Index before it occurs in price. Look what it did here in price. See, price is doing the double top over here. And you're right. I have some folks saying, well, Dean, I see the regular divergence. Absolutely. We have divergence here too. See that? You see this? So there's a number of things going on here that you see, regular divergence, and you see a double top in the pattern, and we come over. And we already know we're up high here. It comes over, and then it turns right there. And look what's happening here. Take a look at this picture. Would you agree with me? Take a look at this. Would you agree with me that the green line here is about at a 530 angle? Think about this. If I was to zoom in right here, that green line's going down about 530. Green's under red, under yellow from a high point. Does this follow suit with what we just talked about, looking for trend and angle? Absolutely it does. The charts that I'm showing here is the basic synergy chart, correct, because you see the price up here that kind of follows the synergy model, but the focus of attention is on the Trader's Dynamic Index right here. So we have a nice setup, reversal signal coming over right there. Everything's looking great, okay? Let's see if I have another example here. Here's another example. Could I show the slide with rules on it? Give me just a moment and I'll go back and I'll show the slide with the rules on it. Okay, Mark? In this case right here, you can see that the market baseline comes up towards the 68, starts to roll over. Look at current price falling through. See how price makes a complete run out. And this is a daily chart. Now, like I said, on a daily chart, they can go beyond the levels. So in this case, look, it goes beyond the 32 here. Okay, it goes way beyond the 32 here and starts working its way back up. Okay, starts trying to work its way back up. The market baseline comes down, kind of stays flat, and starts making a roll back up. Current price is making a push back up, and look what happens here. We finally get a turn. So here's a reversal, and there's a reversal, and that was on the daily chart. Okay. So you will see these over and over again. And again, in this example, I have a daily chart. And the previous example was a 4-hour chart. Okay. And then here are the rules right here. For those of y'all who asked me to put the rules back up, there are the rules right there. Okay. Okay. On the daily chart that I just showed, the question is, could you drop to a lower time frame and trade from the lower time frame? Absolutely. Yes. Now personally, as I trade, my high time frame, since I trade typically on a 15-minute chart, my higher time frame is a 4-hour. If you're trading, let's say, on an hourly chart, maybe your higher time frame would be the daily chart then. Okay? All right. So those are reversal signals right there. And again, the SP stands for swing position. So SP reversals, if you're using a 4-hour or daily and you're seeing this happen, typically what can happen in this situation is that the fact that the trade can literally go for hours, if not for the day or longer, potentially, on it, okay? Now, let's talk about another type of reversal, but this is an intraday reversal. I call it the TDI Hook. The TDI Hook is something that I've heard other traders, I've talked to other traders about it. The hook, to me, was an exit signal, but I found more and more traders using the hook as a potential entry signal. There's just a few caveats you have to know when you're trading a reversal intraday, is you have to know that there are other potential reversal indications in the marketplace that can help you identify if it's a good reversal or not. And you got to be aware of that. You also got to be aware of the overall trend. If the overall trend is real strong, you can get caught upside down in an intraday reversal. So you got to be aware of that as well. So let's go through the TDI hook. What we're going to look for is a green line to move beyond the blue volatility band and to hook back or cross over the blue line, and oftentimes it's better if it's crossing both a blue and a red line. We'll see that here in just a moment. Look for divergent signals and confirmation from other indicators. That's key. Okay? Look for divergent signals and confirmation from other signals or other indicators. Okay? Enter a trade with a tight stop loss above the previous high or below the previous low, depending on which way you're trading the hook. So if it's hooking down, I'm going to put my stop loss above the previous high point. If it's hooking up, then I'm going to put my stop loss below the previous low. I'm going to exit the trade as price action and the indicators reverse near the previous highs or lows or at a Fibonacci extension level. That's kind of how I trade it. So let's go through that. There's a lot there. Hopefully you've got all that down. And let's take a look at what this looks like. Here's an example where the market has made a pretty good move to the downside. It's bounced up to maybe a 38.2 retracement level, has come back down, and now it's more or less looking like it's in kind of maybe a bullish pennant type pattern. Well, I'm sorry, a bearish. This would be a bearish type pattern. You can see higher lows, lower highs coming down from this. It looks like to me a bearish pennant pattern. With a bearish pennant pattern looking to make a move down. Okay? So let's take a look here as what happens. So I get the hook. This is what I refer to as the hook. It comes over the blue volatility band and hooks back over. Okay? At this point, I'm going to look for things. Now, here's the example of hidden divergence. Okay? Someone was asking me earlier for an example of hidden divergence. This is it. You can see that I've got lower highs in price and higher highs in the Trader's Dynamic Index. When you have higher highs in the green line of the Trader's Dynamic Index and lower highs, that is potential continuation. So with a strong downward trend, there's a likelihood that we could see this move on down. And I've already identified the price pattern as being a bearish pennant. So to some extent, the odds, in my opinion, are in my favor to make a move to the downside. Let's take a look. So let's say I enter the market short at 37.49 in this example. At that point, there's a number of things you can do as far as an exit. You can exit if it comes back down to the bottom here. What I like to do is I like to see that the price reaches a 127 extension. And some of y'all have seen me in my trading room do the 127 extension. Another thing to look for is when the green line hits the low volatility band. So it comes all the way back over. Now remember, let's go back. See, it's way up here, okay? And then the green line comes all the way across and hits the lower volatility band or gets real close to it there. That's another potential exit. So I have two exits here, but there's a third exit, and that would be if it just makes a move back down to that previous low. And you can see it kind of came down the previous low right there, bounced around a little bit, and then pushed down lower. Okay? That's what it did. Okay? That is an intraday reversal signal following the price action, following following the hidden divergence, and then trying to get the most out of the trade I could. Sometimes it'll just go back down to there's that low, and sometimes maybe just the previous low and bounce off of that, and that would give you then two bottoms here, and we could possibly work off of that. Now let's take a look at the same trade here as it makes a bounce back up. Again, we have another TDI hook. Now we just exited the trade when it touched this, it went below, and now it's starting to come back up. So we have another TDI hook possibility here. Let's take a look and pick apart this potential trade. Now, if we're going to go long, the overall trend's against me. So I've got to look for other indications that can more or less verify or confirm to me the potential for the market to go up. So you can look for regular divergence. Regular divergence, remember, is the reversal signal. So I need to see reversal from the trend to the downside. Now, interestingly, I see reversal also in my market baseline. We're going to talk about this too, but notice something here. Notice what my market baseline's been doing. Can someone tell me what the market baseline's been doing? Take a look right there at that black line. What's the market baseline been doing? It's been rising. It's been moving up. Oh, there's something there. Remember I mentioned there's kind of a bonus technique avoiding the hidden trends, or at least being aware of the hidden trends? Well, look here. There's a little bit of a hidden trend there to the upside. I've got regular divergence in price, indicating reversal, and then I've got a slight hidden trend right here in my market baseline. Okay? Now what I'm going to do is also verify with maybe some other indicators. And I just put a couple up here. You can choose what may be suitable for you. I just happen to put up a CCI and Williams percentage R. I know one of our traders who uses the Williams percentage R, one of our clients rather, who uses the Williams percentage R. I know other clients that use stochastic. Okay? So in this case, they're moving up. This is moving up. Getting the hook here. I've got that slight hidden trend to the upside of my market baseline, and I've got regular divergence. So with the potential going up, I can do a long entry at 37.25. Now let me ask you, where do I put my stop loss? Because I know I'm going against the trend right now. So where do I put my stop loss? This is important. Where do we put our stop loss? The last low, exactly, right below the last low. Very good. So we put it right down here in this area, right there. Very good. Now in this case, trade happened to work out very well. Now, there were places along the way that you could have probably exited, like might have exited right here when it was starting to come in, but it bounced off of the price action channel. And it came a little bit, well, it kind of rode it, came up, came back in. So there were places, I was, in this case, just looking for the average price bar that I use in my own synergy model to turn red, and it turned red, was starting to go up and down, and just turn, just close the trade. This is turning over, this is turning over, price is turning over, TDI is turning over, CCI is dropping, and the Williams percentage R is dropping. Okay? But along the way, there have been maybe some other exits along the way in this case. That's the hook. So we trade off of this guy hooking down with the trend, and we traded this one against the trend, but we had a hidden rising upward trend, and we had other indicators verifying movement to the upside. That's trading the intraday reversal known as the TDI hook. And in the new TDI, one of the alerts is to alert you of potential TDI hooks. Okay? We'll talk about that in a little bit here. Any questions on the TDI hook before I move to our next strategy? Some folks are asking me, would you please go back over the rules? Here are the rules again for the TDI hook. We're looking for a green line to move beyond the blue volatility bands and to hook back or cross over the blue. Looking for divergence and other confirmation from other indicators. We're entering with a tight, we're entering with a tight stop loss. And then we're looking to exit based upon price action and the indicators. And again, folks, this training is being recorded, and you're able to go back to the recordings at any time if you miss something while taking your notes, okay? So if you just happen to miss something, don't worry about it. It's all being recorded, and you can go back over the recordings. What is the meaning of the rising baseline but hook showing continued move down? Yeah, this is starting to rise just a bit. In this case, I would much rather go with the overall trend of the downside, okay? I'd much rather go with the overall trend of the downside, even though this is rising up a bit, because in this case, there's greater potential since I see a price pattern, a bearish pent to the downside, overall trend to the downside. I'd much rather trade it down, okay? Now, what we look for, Suzette, is if this comes down and bounces off the market baseline and pushes back higher, then we know that this hidden trend, this hidden rising market baseline has meaning. And then we just come out of our trade off the bounce of the market baseline. Okay? So in this case, let's say we entered there and the market came down and couldn't go any further. It just kind of stopped right there and started bouncing back to the upside. At that point then, what we'd be looking for then is to come out of it. To answer your question, Suzette, it had to punch through the market baseline to make its move on down. If it wasn't going to do that, then, and it was bouncing off of that, I would take off the trade. Okay? A good question. Okay, let's go move on to one of my favorite strategies is the TDI Squeeze. I'm telling you what, folks, if you can see this and it occurs, when you see it, it's easy to see, and when it occurs, it's a highly favorable trade, okay? For the most part, there is one example where the trade could go either way. And here's the concept. What we're looking for is the blue volatility lines to compress or squeeze together. And what we're going to do then is we're going to identify placement of the green, red, and yellow lines to determine the potential break direction. Okay? So wherever the green and red line, the green line, red line, yellow lines are related to the blue volatility lines compressing down or squeezing down, we're going to know a potential direction. Then we're going to enter the trade with green, red, and yellow line crossover, or the green line breaks the blue volatility line, and exit when we cross back over the opposite side, the opposite blue volatility line, in that opposite direction. Let's take a look. It's easier when we just take a look at it. Now then, here's a great example of what I refer to as the squeeze high. Okay, and this is something that, make note here. Notice this. You have the 68 level right here. And notice that you have 4 of your 5 lines above the 68. And notice that the lower blue volatility line is above the 50. Folks, this has the whole situation in the market is shifted up. Let me share something with you. The market baseline likes to go back towards, and hear me out, the market baseline likes to go back towards the 50 line. It does it over and over and over again. It likes to go back towards the 50 line. Okay? So make note of that. When you're trading, look for the market baseline. If it's way up high like that, up over the 68, it's off track. It needs to come back to center. The center point is that normal mid 50 level right here. And that's what it's looking for. Okay? The squeeze is something that's synonymous with what John Bollinger wrote about the Bollinger Bands, and others have talked about as well. So this is a beautiful strategy. So there's the squeeze high. Let's move on. Here's the squeeze low. Okay? You see how everything's moved down? Look at this. Look at this right here. This is beautiful. You've got 4 of the lines. Look at this. It's as if I reached out in the marketplace and put my put my hand right on the lines, and I made a fist. I squeezed them all together. Okay, right in that area. I've got the yellow, the red, the green, and this other one. I got 4 lines below the 32, and I've got this upper volatility band below the 50. This is a high probable situation that it has to reset itself. Remember, the market baseline, the yellow line, likes to get back to 50. And sometimes, if you notice here, notice how we went from one side and we went almost all the way to the other side. It happens. Sometimes when the market goes so far one way, it overreacts and overshoots the 50 level and goes to the other side. So there's a squeeze low. And so tomorrow morning and Wednesday morning, one of the easiest strategies to look for when we're trading is a squeeze high or a squeeze low. So again, here's the squeeze high. We're way up high, okay? We're way up high. And if the market's going to get up here like that, there's a great chance it's going to come all the way over. And look what it did. It, again, shot right past the 50 as it moved down. Okay, so we'll look for these. Now, here's another example, probably a better example to squeeze low. But in this case, I'll take that back. Actually, that was a better one right here because they're all below. I got 4 below the 32. But I need to let you know that sometimes you get a squeeze and they won't all be below that 32. But you can see that the market baseline was below the 32 right there. Those were a little bit earlier, but right about that point right there, they were all right about the 32 except for the upper volatility band. Now, the one that's the most difficult to trade with, folks, is the squeeze in the center. You see everything comes right there to the center point. This sometimes, I've noticed over the years of trading, this sometimes is like the night before non-farm payroll. The market doesn't do anything. And all of a sudden the announcement comes out and it makes a strong move. Okay? So in this case, the question, someone just wrote me a question, does this show possible large moves for swing positions? Absolutely. Look at this. I would say that this made a move nearly 100 pips there. Right there. That's a pretty good move. And that's a 15-minute chart, and it looks like it went for 1, 2, 3, it looks like about 3.5 hours right there. Now, a swing trade, and, you know, my thinking is a swing trade in the Forex is an hourly, is over a few hours. I used to trade stocks, and a swing trade would be for like 1 or 2 days. It's not like that here in the Forex. But back to this, squeeze center can go either way, so be cautious of this right here. Okay? Now then, there are a few times they happen, but there are a few times where we have what I would call an extreme squeeze low. This is where the market has made just an incredible move, and you notice how all 5 lines are below the 32. Now you would think that, oh my gosh, that made such a big move down. It's got to bounce back. The only thing about an extreme squeeze low is, and the same thing goes for extreme squeeze high, is that the market may be making a big shift in the other direction. So we may only get a retracement here. So even though this looks like this should just go way to the other side, that doesn't necessarily mean that price is going to go all the way back up. The price will maybe make a retracement. But still, there again, if we catch this way down low, it can't go any lower, folks. Well, price could try to go a little bit lower, but eventually market sentiment is going to turn here enough to where we can get a 23.6 to a 38.2 retracement. Just run your retracement levels from top to bottom. You can see it here in the extreme squeeze high. See here? Now, all of them right there at that moment, all of them are above the 68. But look what the market does. The market's not ready to give up the high yet. and it takes its own sweet time before it finally drops. And you know, it tried it once, didn't do it. Twice, didn't do it. 3 times, didn't do it. By this time, most retail traders are thinking it ain't going to go down. Look, it's made higher lows here. It ain't going to go down. And then when the retail traders aren't looking, what happens? Boom, it goes down. Okay? But that is a squeeze high. Now, when it made that squeeze high, if we were to run from this point to this point, it might have made a 50% retracement right there. Okay? But I don't know what this is. I don't know if that's a 38.2 or if that's only a 23.6, then I have to go lower to wherever it originated at, run this up. This could only be a 38.2 retracement. So again, on the extreme squeeze low and extreme squeeze high, look for your normal retracements of 23.6 to 38.2. Keep an eye on it and see if you get a 50% retracement of it. But, folks, I'm telling you, when all 5 are above the 68 or all 5 are below the 32, that's pretty much easy pickings. Okay? Just about only one direction it can go. Alright? Now, let's cover the last strategy. Now, like I said, the squeeze is probably the easiest. I don't see the Fibonacci levels at all. Okay, let me go back. Okay. When I trade, Fibonacci levels are like imprinted in my mind's eye. I can literally run a fib in my mind's eye from the low to the high, and I can determine that that's about 50% right there. Okay? So if you just take a look and you can see the low here and the high here, that would be about halfway. It might be a little bit more, but that's about halfway right there. Okay? This is a strategy that I shared with a client of ours. This client of ours is a retired airlines pilot. And he made a comment to me one time. He goes, Dean, you know, I'd be up there at 30,000 feet myself and 200 to 300 passengers in the back, and I'm putting all of our lives in a bunch of instruments. Especially, you know, if it's just mud out there. I'm in the clouds, I can't see anything. I put all of all of our lives into these instruments. So when I trade, he said, I put my thoughts, my abilities, my whatever into my indicators, into the instruments in front of me. I have to trade by my instruments. Okay? And that's actually called IFR. Instrument flight rating. So anyway, the reason why I share this is because there's a certain thing that with the hidden secret that he caught on to, and he's traded it on and on. I mean, he trades this over and over and over again. He looks for this certain setup. So under normal trading conditions, or shortly after a squeeze condition, what we're looking for is a green line to make a strong angle or breaking the blue volatility line. Okay? Now, what we're going to look for is the typical angle of the green line. I take it back. What we're going to look for is a stronger angle than the typical angle of our green line. So if it's going long, we're looking for that 12:30 to 1 o'clock. If it's going short, we're looking for that 5 to 5:30. We're looking for a real strong angle on this. Okay? Now then, this is key. I can't stress this one enough right here. I mean, make note on this particular one right here. Okay? Make note of this one right here. A blue volatility line that you're breaking should be near the 50 or closer to where, let's say if we're having a squeeze high, that blue volatility line being a little bit higher than 50 or near 50. That is a key component of this technique, and we'll see that here in a moment. We're going to enter the trade on a break of the blue volatility line, exit the trade as the green line crosses the blue volatility line in the opposite direction, or less it does a hook. Okay? Now, this is called the hidden secret because many people don't know about, they don't see it. It's right there in front of them. It's not really hidden. But they don't realize that when we break the blue volatility line and that volatility line is up fairly high if we're going short or fairly low if we're going long, the market's got to shift back to a normal. Remember when I said the market baseline wants to go back towards 50? Well, if the market baseline is down low and the volatility bands are down low, well, guess what? When we break that blue volatility line and we go up, I mean, I'm not saying that there's blue skies above, but there's a lot of potential room to run. Let's take a look. Here's an example where the market kind of got flat right here. Now notice a couple of things here. Notice the angle of the green line here. That, would you agree with me that that angle is about a 5:30 on the clock face? Who would say that that's about 5:30 on the clock face? That looks pretty darn close to me. We've got good angle and good separation going on here. Now then, notice that the lower blue volatility band is right near 50. You see that? So in a way, the market's kind of shifted up a little bit. Okay? And then we break. Okay? So again, we could have probably been in the trade a little bit earlier. We may have added to the position, but sometimes what this client does is he looks for these setups. He's like, Dean, when that guy breaks right there, and that blue volatility band is right around the 50, and I got this type of an angle, more times than not, we got a good trade. You got good, strong energy, good, strong strength in the market right at that moment. And what's going to happen is the market's going to drive strong for a while, and then it's going to kind of let off the gas. But guess what happens? Just like on the freeway, when you get behind someone and you want to pass them and you step on the gas and you pass them and then you let off the gas, the car doesn't come to immediate stop. The car's got so much inertia that's going to keep on going forward. You're going to have momentum that's going to drive that car forward even without that foot being on the gas. Now, will it slow down a bit? Absolutely. Momentum's going to slow down a bit, but look at this. As momentum is slowing, look what the trade does. It just goes down and down and down and down, and then finally it looks back over. And what you're catching is what a lot of people don't catch. That continual momentum in the marketplace. So let's say, for instance, we entered the market, this crossed over, and I'll try to put a line straight up here. Let's say we entered on that red candle right there. This first red candle comes down, and we entered there. But you notice by our second red candle, I'll draw that second red candle down. Notice with that second red candle, if I get it set here, get the line set, if you notice in that second red candle, what did we do? We broke the blue volatility line. When that happens, this friend of mine tells me, Dean, I just let go of the mouse, and like you say, I step away from the keyboard, I let the thing go. And he goes, it could take an hour, 2 hours, 3 hours. Sometimes I've seen, he mentioned, sometimes I've seen trade go overnight, just dropping, just gradually, just going lower, going lower, going lower. At that point, you know, I mean, he's well into the trade, and he moves up his stop, and he trails the trade. But the idea is that you're catching the momentum of the move. Let's see another one here. Here's another one. Notice again, got a nice, good angle. Would you agree with me that that angle right there is probably around 1 o'clock, 12:30, 1 o'clock? The green line is. And look where that blue volatility band is. Blue volatility band is right at 50. Now again, could it be a little bit lower? Yes, it could be a little bit lower. Okay? But right near the 50, and it breaks. And then look at this run. This is on a 4-hour chart, folks. Look at this guy. When we break, just when he broke, okay? Now we might have entered on this one right here when it came across. So we entered, let's say we entered right there, okay? And then actually it's the next bar where we break the blue volatility band. I think it's the next bar if I get this right. Yeah, on the next bar we break the blue volatility band. And then look at this guy. He goes for another 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. He almost goes 2 days here. Wow. Man, I wish I was in that trade. So anyway, this is what this trader does. And he says, Dean, I look for these over and over and over again. And then he goes, there's my exit. When we cross over, when we close, we're done. And he goes, you know what, Dean? Looking for this, and he trades on the 1 hour chart. That's what he does. He trades on the 1 hour chart. And he goes, Dean, I only have to do this a few times. If I do this 20 times a month, I'm good to go. He goes, I can literally make 1 to 2 trades a day, and that's it. And I just let it go. Now he goes, do some of them not work out? Yeah, some of them don't work out. Some of them have this great look. Whoops, excuse me. Some of them have this great look right here, and then somebody in the news says something, and poof, it just goes bad. Okay? It just turns and goes on him. Well, at that point, he's got his stop. He's got risk management in place, but he goes, more times than not, if I'm in the normal direction of the market and the favorable direction of the market based upon fundamentals and other things I see from technicals, it goes. So watch for this. This is a nice trade. And again, like I said, this gentleman, Dave, he's a great man. I mean, just a great guy all around. And we've had a pretty good friendship now going on, almost 4 years now that he's been using Advanced Synergy. He's been using, it took him about a year to figure things out for himself. And he's like, Dean, this is the trade for me. Because he goes, number one, I don't like to sit in front of my charts day after day after day, or you know, hour after hour after hour. And he's got a little setup that he looks for this right here, and he gets a little alarm, goes off, and he's good to go from the strategy right here. So that's the hidden secret. Okay, and I've done videos about that, and it's been overlooked, but it's a really good strategy. Now, I want to share with y'all, before we go into our next break, I want to share with y'all a little bonus here. I've never shared this with anyone before. Y'all are the first group I've ever shared this with. Okay? So, this is about avoiding hidden trends. And hidden trends can get you into a predicament. I'll put it to you that way. Okay? Hidden trends are established using the market baseline. We're following the market baseline, the yellow line. Okay? Now, remember what I said, the market baseline is our overall trend. It's also our dynamic 50 level. But there's something within it that a lot of people haven't seen before, and myself and another trader have taken notice of this, and we're really honing our skill on using the Trader's Dynamic Index. And what we're looking for is we're monitoring the highs and the lows of the yellow line. Monitoring the highs and the lows of the yellow line. Let's take a look. And I'll give you an example here. Now, right here we have a TDI Hook alert, and with the new Trader's Dynamic Index that y'all will receive this evening, that is a TDI Hook down alert. It's right there. Everything's set up just perfectly for this. Okay, based upon just the alert itself. But something of note I want to share with you. What's the market baseline doing? Look at the market baseline. What is it doing? The market baseline is rising. When we get this alert, we have a higher low than the previous low. As a matter of fact, this low point is higher than that low. So we literally have a rising market baseline. This is the hidden long trend that people don't see. But we have a short signal. I mean, wouldn't you agree with me? If you were just looking right here, if we go back, and you look right here, it's like, oh my gosh, Dean, there it is, green, under red, going down. Now, we'd have to get through the market baseline, and Dean has said sometimes it may bounce off the market baseline and go back up. And that's when it hit me to look at the market baseline. Why sometimes does the green line hit the market baseline and punch through, and other times it bounces right off of it? It could be because of what the market baseline, the hidden trend within the market baseline. And look what the market does. See, the market makes a move up. Now let me go back. Let's take a look at this again. Here's our alert. We only have 2 red going down. There's the rising market baseline. And then take a look. 2 down It didn't even come to the market baseline. The market just stopped and went up strong. This is a situation of avoiding the hidden trends. Now, you don't necessarily have to have a hook situation happen. We could have a situation like right here. The market was trying to come down right here. Okay, the green line rolled over, started coming down, couldn't do it. Here it again. See how it's trying to come down right there? Can't do it. But look right here. You will notice that we have higher lows in our market baseline. Does everybody see what I'm talking about here? Everybody see that higher lows in the market baseline? Okay? That's almost that hidden gotcha. Okay? So we want to be aware of that. Let's take a look at another one here. Okay, in this case, we have, this just happened the other day, the TDI Hook Up alert. So we have the Hook Up alert right there, got a green arrow telling us to go up. Look at the market baseline. Now this is not exactly set just yet to go into it, but it's giving us an alert that we've made the hook. Look here, we have a falling market baseline. We have lower highs. Now, if it's going down, if the market's going, this is a hidden short trend. Lower highs are a hidden short trend. And then look what happens to the market here. Look at that market. There was our short entry, and look what it did. Look, the green line came over, just couldn't. The market baseline didn't even go towards. The green line didn't even go towards the market baseline. It just went flat and fell over. Okay. So the market follows, again, the falling market baseline. Could it be divergence? Yes, it definitely is divergence. When you've got the hook going one way and the market baseline going the other way, you're right. Now, let me ask you, why would the falling market baseline take precedent over the rising green line or the rising hook? Why would the falling market baseline take precedent or more importance than the rising green line? Why is that? This is a great question, and some of the reasoning behind it. No, not necessarily that the yellow line is a leading indicator. Bingo, Ronald, you got it. Is the market trend? Bingo, Eric, excellent. Good, Jim. Is the overall trend, the market trend. Remember, green and red represent current price activity. But current price activity doesn't necessarily mean that's the direction it's going to go. And when you have the overall market, the overall trend, the market trend making lower highs, guess what? There's more potential to move on down. Jot these notes down. Avoiding the hidden trends. First off, and I want everyone to jot this down, be careful when taking a short when the market baseline, the yellow line, is rising. And how do you know it's rising? It's showing a higher low than the previous low. That's key. So write that down. When taking a short, when the market baseline is rising or having a higher low than the previous low, be careful on that, okay? Now then, be careful when taking a long when the market baseline is falling. And what I mean by that is it has a lower high than the previous high. That's your hidden trend. And I'm telling you what, folks, I've missed it. Other traders have missed it. But I was talking to this other trader the other day, not too long ago, and he was making comments to me. He's like, Dean, you don't teach this, but something I've seen over and over, and I'm really focusing my attention on it, trying to really refine my trading of with the TDI. And he goes, have you ever noticed the higher highs or the lower lows? The lower highs or the higher lows in the market baseline? And I said, yes. He goes, have you ever noticed that if you try to trade against those, oftentimes or many times, the market won't go your way? It will go the way of the market baseline. I said, yeah, I have seen that. And you're right. Until the market baseline reaches the 68 or until the market baseline reaches the 32, and then you start getting into an exhaustion. So you got to be careful of these. So hopefully everyone is jotting this down right here. This is key.